Hello, I'm Andrew Winter, host of Selling Houses Australia, and welcome back to the fifth and final part of Compare the Market's Mortgages Made Simples. Today we will be discussing the last of the 5 C's, which is conditions. More specifically, the conditions of the home loan you're applying for and your current personal condition. Let's get stuck in. First of all, the loan conditions. The initial step here is figuring out what kind of home loan you want. Variable, fixed or maybe split rate. If you're borrowing to invest, perhaps you prefer an interest-only repayment structure to keep your repayment costs lower for the first few years. Once you've figured out the type of loan you're after, it's time to think about your desired loan term. Most borrowers will opt for a 30-year term to stretch out their repayments over the longest period possible and subsequently keep them as low as possible. This is an absolutely fine way of thinking for first home buyers and for new home loans in general. But if you're refinancing, you may find that refinancing from one 30-year term to another could really dramatically inflate your long-term overall costs. With that in mind, you might want to think about refinancing to a term that's similar to what's left on your current mortgage. And as we mentioned previously, if your desired loan term would take you past the age of 67, the bank will want a fairly detailed explanation of how you plan on repaying your home loan past retirement age. Let's talk home loan features, shall we? The first thing to flag is that while features can be a huge driver of value in a home loan, they're not always free. Take offset accounts, for example. It's an account linked to your home loan, and the balance of the offset account is subtracted from your home loan balance when the lender is calculating how much interest to charge you. They're fantastic, and it can be tempting to sign up for an offset account, thinking this will save me so much interest. But the reality is that offset accounts usually come with a higher annual cost. That means that an offset account may be a great idea later on in your life when you've got more cash floating around that you can stick straight into a new offset account. But if you're a first home buyer, an offset account could cost you more money than it's saving you. A redraw facility, on the other hand, will usually be free, but it doesn't offer quite the same utility for saving money. Redraw is an easy way to access the extra money you've put into your home loan. The value you get out of a redraw facility will obviously vary depending on your personal financial circumstances though. And that's what makes genuinely thinking about this stuff so important. Maybe you're less concerned with fees and keen on a wide feature offering. Maybe you're budget conscious and want a no-frills home loan that gets the job done and not much else. Either way, you can't just tick the boxes and sign up for whatever sounds good. You need to think about where you stand and decide what's appropriate for you based on your wants and needs. I mentioned extra repayments a few moments ago, and that's another big one to consider, along with repayment frequency. If you do suspect you'll be able to make additional repayments on your home loan, a fixed rate loan may not be for you. They usually have an annual limit on how much extra you can repay on your home loan and may even charge you a fee for making an additional or larger repayment. Variable rate home loans, on the other hand, typically let you make as many extra payments as you like with no fees for making extra repayments and no limits on how many you can make either. So that's an important distinction to keep in mind. The only thing I'll say about repayment frequency is that not all home loans let you choose between weekly, fortnightly or monthly payments. Not only is flexibility valuable, but the more frequent your scheduled repayments are, the more you'll save on interest over the life of the loan. It's not hard to find a home loan that lets you choose your repayment frequency, which makes it more important to keep an eye out for the ones that don't. Now, onto your personal conditions. By that we mean things like your life stage and what you might have planned for your future. For example, a lender may want to know if you and your partner are planning any changes that will impact your future income or expenses. For example, planning on having a child in the future or changing jobs. Seems a bit personal, I know, but having a child typically means more expenses and less income. So the lender will want to, with your input, develop a contingency plan and discuss options for keeping you financially secure during that lower income period. That goes for any major future changes really. Whatever it's about, you'll want to flag any significant plan changes with your lender. The stability of your employment will also play a part. We touched on this in the second C when we were talking about capacity, but it's relevant here too in terms of your personal conditions. As we've covered, lenders will look for evidence that you are established and embedded in your industry and role so that they can rest assured knowing there's not much of a chance you'll be out of work anytime soon. However, they may also ask about your future plans regarding your employment, wanting to hear you say something along the lines of, "I am not planning on quitting my job anytime soon." It won't do anything to materially change the logistics of your home loan application, but it will help the lender feel more confident in handing you a great big wad of cash. And if you are applying for a home loan with a term that would take it past your 67th birthday, the lender will want to talk about something called an exit strategy. This basically means they will want evidence that you'll be able to continue paying off the home loan beyond the point at which you retire. Lenders use 67 because that's ostensibly retirement age, but you might be planning on retiring early or working a little later in life, so don't get too hung up on it. But you'll need a plan either way. Maybe you plan on selling off assets to fund your home loan repayments going forth. You could have plenty of superannuation built up and ready to go. Maybe you make 10 figures a year and simply don't have to worry about it. In any case, your lender will definitely want to talk it through with you and get a grip on how you plan on continuing to service your loan, so be prepared for that. That's all 5 C's covered and the end of Mortgages Made Simples. Hopefully you are feeling confident about the knowledge you've gained from these videos and ready to give Compare the Market's new home loan service a go. It has everything a prospective home buyer could ask for, including real-time property reports, a borrowing power calculator, a credit score fetch, and the ability to model countless different home loan scenarios that you can even base off the exact property you want to buy. And once you're ready to apply for a home loan, you'll be guided through the process from start to finish with Compare the Market's home loan specialists on hand to answer any questions you have. Once you've finished filling out your initial application, they'll handle the rest, from identifying a home loans you might be eligible for to filling out and submitting all the necessary documentation on your behalf, once you've chosen the home loan you want to apply for. So if you're ready to compare, apply and settle, then Compare the Market's ready to help you.